Hello, this is Ken Tomko with T2 Asset Management doing our monthly video review of what's going on in the markets. As always, please don't use these videos for trading purposes. They're for education only. We always start here with the weekly chart of the S&P 500, and this goes back to the left side here would be 2019. So you can see the date labels below here. And despite all the talk in the past year or so of a recession coming, a slowdown, you can see what the market's doing. Not only has it started a new uptrend, as we've described in prior videos, it's moving even quite away from its trend line. I mean, we've had just a heck of a rally here since about Thanksgiving time. As the market moves on to new highs, we described in the past that that was a possibility, and don't want to argue with the market. And now we're seeing it happen. It's very aggressive at this point. So the long-term trends, certainly the weekly trend continues to be upward and doesn't show any signs of relenting at the moment. If we move here to a daily chart of what's going on, see a little more detail, give us the last about 2 years of trading, and there's the last of the bear market and the choppiness there in 22. Rally starts in 23 and starts to retrace a bit. And then since, as I described it, since November, it's just been absolutely on a tear here. As you can see, hardly letting up at all. In fact, off of November, I mean, we're up 1,000 points here, over 1,000 points in the S&P 500 here, just since Thanksgiving, which is just, I don't think anybody was really calling for that. But we have described that it's been in an uptrend, and you don't want to argue with it. Certainly, you could be cautious in your outlook, but you wouldn't want to not be invested in this environment because the market's not telling you to do that. Come here to a little more detail, a 2-hour chart. This gives us about the last 6 months trading in the S&P 500. You can see the nice channel that we have working up. Certainly, have had a couple sell-offs here or there, but nothing that's been able to derail any of the trends as we just keep working our way higher. One of the bigger concerns that we've had looking at it, and I've been slightly light here through this rally, is some of the breadth measures. And if you come down here, this is the percentage of the S&P 500 that's in an uptrend. And it had been, going into Christmas up 80% or so, and in recent weeks it's gone down to about 60. The New York Stock Exchange here, this is the advanced decline line on the New York Stock Exchange, had rolled over to flat, even though now it's starting to accelerate. Actually, both of these are starting to turn up a little bit. And the volatility index here, the VIX, had, it didn't get to the really low number. I mean, we got down to 11 there in December, and it started to kind of move a little bit higher here through February, through March, maybe a little bit. So there were some of the internal measures that could have told you, hey, sell-off might be coming soon. But these seem, other than the VIX is a little higher here, but some of the breadth measures are actually starting to turn positive again, even though those were reasons for concern as we moved on to new highs here. And it was, I guess, slightly choppy, but they really haven't come to fruition. And really what we're seeing is a market that just continues to rally in the face of the talk of a slowdown and what have you. If we come here and look at our culprit for the 22 bear market, this is the interest rate on the 10-year Treasury, and you can see that we went up from all the way about 0.5% in 2020 to about 5% in recent months. But as that had started to back off and continues to look like it's backing off now, signaling that maybe the Fed is going to lower interest rates. That's having a positive effect on equities. And so this is a key chart to watch here, that as long as interest rates start to back off, we're probably going to continue to see a rally in the market. If we look to some of the economic indicators, here, go to trading economics, the GDP growth rate, it's actually slowing down from the previous, but still a very strong read there. All the growth rates, everything is strong there. We go to non-farm payrolls, the jobs numbers, they're still over 300,000 payrolls on each reading here, all very strong. Point of concern I do look at is retail sales are starting to fall, at least on the last reading, but overall the economic numbers are still fairly solid. We go to the forward estimate for earnings in the markets. well, it's not pulling up here, of course. Oh, there it is. We see that the forward estimate, so this is analysts' estimate of what earnings will be in the S&P 500 going forward into here the fourth quarter of 24. It's still strong and moving to all-time highs. So not really seeing a lot that's going to tell us, hey, the market's about to roll over. Point of concern. There are a couple of points of concern that'll show, and probably the reasons why I'm a little bit light at the moment are here is the overvaluation. I use this chart to say, a fair valued. Let's call it a new one is 20 times earnings would be 36.85, and we're trading at 51.51. So it's a very high number where we are in terms of valuation. So things do look good, but the market is getting to be a bit expensive. And another concern that we've had is this chart right here. If we look at the performance here for the year compared to the Dow, the S&P 500, the Nasdaq, not sure a lot of being said about it right now, but you look here, the Dow is up about 3% for the year, and the Nasdaq and S&P are close to 10. And one of the reasons for that is that a handful of stocks in the S&P 500 have just become monsters and are absolutely taking off, and they're dragging the index with it. Some people might know that you call the S&P 500 that there's 500 stocks in it, but it's components. So if we look here, I just pulled up marketscreener.com and pulled up the components of the S&P 500. You see here, and Apple is 7%, Microsoft is 7%, Amazon 3.5%, Nvidia 3%, Alphabet 2%, Facebook 2%. The second Alphabet stock about 2 as well. If you look at that, basically you're talking 5 stocks are now 25% of the index. So while we say, hey, there's a big market rally going on, this is wonderful. Really, what we're looking at is 5 or 6 tech stocks that are dragging the market with it, and that's very dangerous because anybody who is investing and saying, hey, I'm very safe, I'm just investing in a broad index S&P 500 fund. 25% of your fund is 5 stocks, which is not excellent diversification. So something to pay attention to there, and why in some cases we move a little bit away from the S&P 500 because it's becoming a bit of a dangerous investment there. So in total, though, the trend is all higher. There's nothing here economic or trend-wise to look at it and say, hey, look out below. Certainly that could happen at some point, and we may have volatility surrounding the elections or any of the moves that the Federal Reserve might make in terms of keeping interest rates higher. But so far, nothing showing up to do that. So we have the majority of our money long, and probably at some point here, going to be forced to do even a little more, but are waiting for a little bit of a pullback, which probably should happen at some point if we're patient for it. So anyway, I hope this was helpful and informative. I am going to put up our contact information here if you'd like to hear anything more about what we're doing in our portfolios. Have any questions at all, please don't hesitate to reach out, and love to hear from you. And otherwise, we'll see you at the next update. Thanks so much.